Now time to bring you the performance of the Nigerian stock market. Now, the market here in Nigeria has gained 4.46 trillion naira in its year-to-date performance, outperforming the Egyptian exchange, the Johannesburg Stock Exchange, the Ghana Stock Exchange, among other peers on the continent. Now, the NGX All-Share Index, an indicator used to track the general market movement of all equities listed on the NGX, including those listed on the growth board, regardless of capitalization, opened this year at 42,716.44 basis points and closed on April the 29th this year at about 49,638.94 basis points. Headed into the second half of the year now, equities analysts have expressed the view that there exist attractive buying opportunities for profit-taking in the market on key sectors. Overall, the outlook for the global equities market is still downbeat as the global markets continue to experience lukewarm investor sentiment, mainly due to the synchronized shift in monetary policy stance across most central banks that have triggered upward pressure on interest rates, forcing investors to reduce their equities exposure. Well, joining me now live virtually from the United Kingdom as we assess the performance of the Nigerian exchange for the first half of this year and also look at outlook for the second half, I have investment manager and accountant Gbenga Ogunrinola. Thank you very much for joining us on the show today, Mr. Ogunrinola.
Good afternoon, and thank you for having me. It's a pleasure to be here again.
The conversation, doing a half-year analysis of the transaction base that we've seen at the exchange. We saw transactions worth about 1.5 trillion naira, which were attracted by the NGX Limited from both local and offshore investors between January and May this year, compared to the volume we saw play out last year with the figure of about 933.65 billion naira. Irrespective of the seesaw movement we've seen in the market recently, would you still say the exchange still retains that resilience it showed between 2020 to 2021?
Yes, I would say so. The market this year has been quite resilient, and it's been impressive, just like you had in your earlier analysis, that we've performed so many exchanges in the world, the major exchanges in Africa and also in the world. In fact, the major exchanges in the world are in negative territory as we speak, and they've been in that region for the past few months now, especially since the Ukraine-Russia war started. So relatively, we would say that the Nigerian capital markets, the stock exchange, has been relatively resilient. More so when you also look at the fact that the Central Bank of Nigeria this quarter raised the interest rate from 11.5 to 13%. It's been on 11.5 for about 2 years, and raising it to 13% as a full swoop like that, one would have thought would affect the market negatively. And for the market to still be where it is currently, it shows resilience, and it shows that the investors are becoming more wiser and taking longer and mid-term positions as against the short-term positions that they usually take.
Okay, now, in terms of your assessment, I want you to deliberate a little further. How would you also rate the exchange's performance that we've seen from Nairobi to Johannesburg and then Ghana as well? Yes, we know Nigeria is highly placed, but in terms of these other exchanges, what cues can we take and how can we continue to further outperform this performance base we've recorded so far?
So what we need to do in the Nigerian parlance is to actually see how we can deepen the markets and encourage locals to be more involved in the markets. What has been going well for the Nigerian capital markets in the year 2022 has been the fact that we've seen more locals. There's more local investors invest in the market as against what used to be in the last few years, where we have more foreign investors coming into the market than the locals. This year, from the analysis that the reports that the NGX gave recently, between January and May, we have about 87% of locals actually investing in the market as against 13% of foreign investors. So if we can deepen the markets, be more inclusive, have more companies join the markets, get listed, especially some of these big companies, some of the companies that were privatized in the previous governments, like the PHCN coming to the market, and other big organizations. If we can encourage them to come into the market, deepen the market, also encourage local investors to be more involved, to participate more in the market, we'll see a kind of level sustainability in the market, and this would continue to play and not go well for the entire market of the exchange in Nigeria.
Let's also look at some of the twists that we've had in the market. There was this renewed vigor on the floor of the exchange limited just yesterday on the back of fresh bargain hunting on some fundamentally sound stocks. On Tuesday, the positive sentiment seemed like a flash in the pan, but yesterday's consolidation changed investors' perception, to say the least. What do you make of the banking sector trend that was the stocks we've seen so far, and how you see the insurance sector, the commodities market, and a whole lot more playing? To what extent do you see new twists and turns coming to bear?
So the banking sector has actually been the most liquid sector in the market over the years, and it will continue to be because you have a lot of banks that are quoted on the exchange vis-a-vis other companies in various sectors. And the banks are actually the major controller of the money market economy. And the banks have also been very consistent in their profitability and in their operations. And so that has given more investors confidence in the banking sector than any other sector. The insurance sector is coming up. We see some insurance companies also trying to measure up with the banks and giving them some more time, more confidence. We'll see them also trying to flex muscles with the banks. For other sectors, I believe that we've been immune to some of the happenings in the world to a large extent, especially sectors where there are raw materials and other primary resources are, gotten from locals. Such companies are being able to outsmart and go around what is happening in the world economy today, and they are also doing well in terms of their productivity, in terms of their profitability. So with all that in place, we'll see a more robust market where every sector is striving and trying to give the investors confidence for the investments that has been put into those companies.
Let's also have your outlook for the Treasury bills and bond market as well.
Okay, so for the Treasury bills and bond market, since the interest rate has been increased, the investors that would rather have a kind of safe havens kind of investment where they know that the return on the investment is guaranteed, there's no risk involved, would rather tilt towards that market. And since the market has the yield increasing in the last couple of weeks now, we'll see more diversion into that market. And it's likely it's going to be sustained even to the end of the year, where we see those investors that are risk averse going directly into the markets, into the fixed income markets. And but for those that are also seeing the benefits of investing in the stock markets, they would continue to hold on to those stocks and get good returns on those stocks. So it's going to be a situation where you will check what is the return on investment in the equity market, what's the return on investment in the capital markets, and in the fixed income market, and try to marry the two together and see which one you would rather go into, or in terms of diversifying your portfolio, have a bit here, have a bit there, so that you can have a robust and a good mix of portfolio.
Okay, now, just before we let you go now, let's also have some insights from where you are in the United Kingdom, the performance of the London Stock Exchange as well. Can you tell us anything new there? What's playing out?
Yeah, it's not been as good as what we have in Nigeria. Currently, the FTSE has lost about 4.48% year to date. And of course, it's one of the major markets that has actually lost that that amount. In the US, for example, you see the Dow Jones losing as much as 15%, NASDAQ losing as much as 29%, S&P losing as much as 21% year to date. So those are significant compared with what we have in the UK, losing about 4.48%. But you see, most of the governments and the central banks of these companies, of these countries, are on top of their game, trying to see how they can stabilize the economy to ensure that they stimulate investments, they stimulate growth despite the high level of inflation in these countries. In the UK, for example, just recently, the inflation rates were released and it was a 9.1% inflation rate, which is about the highest in 40 years. Same thing too in the US, the inflation rate that was released in May was about 8.6%, which is also about the highest in 40 years. These two economies have increased their interest rates also, of course, not significantly like what we have in Nigeria in the region of 2 digits. I mean, it's just a very fractional 1 digit and about 25 basis points. But it shows that they are concerned about what is happening in the economy. If you listen to the presidents of these countries, you see them telling the populace that they are looking at how they can curb inflation, how they can help in stabilizing prices of goods and commodities. So generally, there's the fear of recession in the world economy. The way it's looking is like it's almost inevitable.
Exactly.
But at the end of the day, I think that we'll be able to sail through the boats and hope for a better and a brighter future.
Thank you so much for your time on the show today, Mr. Gbenga Ogunrinola. It's been a pleasure speaking with you, and the market is closing positive once again today.
Thank you for having me. It's a pleasure always.